In this video, I'm trying to talk or to speak about what we call inflation. Inflation, it means that, an example, $1 in the past, okay, like for example 5 years ago, now it doesn't become a dollar in its value, but the value goes down. Okay? For example, it becomes 50 cents. Okay? So the value go down, and this is expressed into percentage. For example, you say 3% inflation. It means the value of that thing goes 3%. Here, example, I'm not giving just 50% or 4%. It means that each year the value of your money is going less and less. But this inflation, something is wrong with it. Something is wrong. I will give you examples to show you that this inflation, it's not true always. Okay? You say to me, oh, it's always, your money before is worth more than now. I say yes, but there are some exceptions. Okay, I'll give you an example. Housing market. Okay? Housing market defeats this inflation because before 2008, it means 2007 or less, the housing market was too expensive. And you maybe, if you bought your house before 2008, it means 2007, 6, 5, you will have a problem now. Okay? If you don't do like your finance. Why? Because a house which was 300,000 in 2007, this house, I'll give you just an example, is 200,000. The same house, and it is in you in the same neighborhood. Okay, I'm speaking about the same thing. I'm not speaking about other thing. In 2008. So I will ask you a question. What's this inflation do? They say if you bought the house in 2007, 300,000, it is more than this. It's the opposite. If you buy the house, this is the same house. In 2008, you will make a big profit. Why? Because you buy the house cheaper. Okay? You buy the house cheaper. That's why this inflation doesn't work that much. Okay? So if, for example, you save money and instead of buying the house of 300,000, you buy it with 200,000 or less, it means you are making too much profit. And this inflation has nothing to do with the market. You see, I just give you this example to show you that the inflation, it's not always true for everything. Okay? But you can feel inflation. How can you feel it? You feel it in prices of food, for example. Okay? You buy something in 1980. You buy it, for example, with $1. Now, for example, you buy it with, let's say, $12. Okay? This is inflation. It means your money at that time is different from now. The dollar loses value. Okay? But I told you that there are exceptions. I give you an exception, which is the housing market, is that it's not true. That's why if you save money, some people, they say if you save money, it loses value. It is not always. It's not always. Like the stock market is an example. Because you buy something that was expensive before, because of the market crash, you get it cheaper. Okay? And in the future you don't know if it's going more cheap or going more expensive. Another thing is when someone wants to buy a house in 2007, for example, the normal interest rate, it was like 7%. Okay? 7% is too much money you should pay for your mortgage. Interest rate, like an interest rate. Now you buy a house in 2013, it's a 3.75 now, approximate. So you are profiting from the market when it crashes. For example, you buy a house now, it is better than 2007. Those people who bought the house 2007, they pay 7% and you pay 3.75%. So you are winning because of the stock market, because of the housing market. Okay? So your money is always valuable. Your money is always have a value, and sometimes it has more value than what they talk about. Okay? So it depends on the markets, it depends on the thing. Now in the past, if you buy gold, for example, and now it goes too expensive, if you buy now, you don't know the future, maybe it goes down, so you lose a lot of money. Okay? This is about inflation. And just to give you an idea what is inflation, and think about always inflation when you buy stocks, because if they say 3% of the money that you have is inflation, it means you lose 3%, although you don't lose in the stocks, although the stocks are going up. For example, the stocks go 7% a year, you should think that 3% is taken from 7, it becomes 4, so your return is only 4, not 7. Okay? Just to have an idea, because your money when you sell the stock, when you get the money, it's not the same money that it is in the past, except for some kind of a discount or something like the housing market when it crashes. Okay, so always think about this when you invest or you do trading for the stocks. Okay, thank you very much. If you have any question or something about this, just ask. Thank you. Bye.